Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be host. So today I'm joined with Mark Flickinger. How you doing today, Mark?
I'm doing great. Thanks for having me.
Great. Well, glad to have you in the show. And for those of you who don't know you, Mark, tell the listeners a little bit about your background.
Sure, I started operating small businesses, kind of privately held businesses, and then moved into the investing space. I work at a private market investing firm named BIP Capital, and we love bringing the opportunities to invest in the private markets to kind of high net worth investors around the country.
Nice. How did you get started in the field, though? Like, what drew you to this field instead of other things you could have done?
Yeah, I always have liked building things, and so I was a mechanical engineer by undergrad training, and I always like building things that hadn't been built before. So started in kind of pockets in larger companies, worked into a small privately backed company that ultimately sold, and just really liked this ability to build. I moved to the investment space. Always been fascinated by just the ability to help these entrepreneurs partner with them to achieve their goals and kind of seeing the opportunities in front of them. And I always fashion myself as better at helping people with their idea than coming up with my own idea. And so going over to the venture capital space has been great. Been able to work with a lot of entrepreneurs and then also a lot of individuals who are looking to grow their wealth. And I think that's a great partnership where I'm able to kind of do both skill sets, still building a lot of new neat stuff and helping both sides of the table.
Nice. Nice. So, I've noticed over the years, I've been in this space since '99, and I've noticed over the years there's been a lot of evolutions of interest in the alternative markets. Started with hedge funds in the late '90s. You weren't in the cool club unless you invest in a hedge fund. Like
Right.
that was the thing. Like you had to be in a hedge fund, or you weren't cool. And then that's evolved into other areas. What kind of trends are you seeing in the private markets now? Like what is smart money chasing? Where are the best opportunities right now? Like what are you seeing?
Yeah, I think you're right. I mean, alternatives have become this massive bucket where everyone says, "Oh, we need to have alternatives in my portfolio." We focus in the private market space, so these are companies that are privately backed and kind of privately held. They're not traded on public. I think there's kind of two different ways to take that question. One question is the people that are investing in it. It used to be sort of saved for institutions, endowments, et cetera. And now I think with sort of the cutting in half of the number of public companies that are available to invest in from kind of the late 90s, early 2000s, more and more individual families and households are saying, I really need to have private markets. I think one trend is really more and more people building funds, building access, building ability for people to have ability to invest in those things. I think the other way to take that question is really what are people doing today? And obviously, everyone's talking about AI. I think there's tons of money going into AI. That's not really, in my opinion, kind of where venture is now. I mean, those are much bigger checks, although it's still venture investments. But I think the opportunities to invest in businesses right now, just because the markets are kind of locked up in terms of acquisitions and sales, and there's just less money going into it, but there's still great businesses being built. So there's a lot of opportunity to invest in businesses that are still doing good stuff, solving problems, but the cost to get in is much lower than it's been in the past.
So explain to me why, I mean, I understand this at some level, but why are so many wealthy people putting money into the private markets instead of public markets? Yes, the number of stocks have been cut in half, but there's still big companies out there that can accept the liquidity, and there's still enough good companies that you could argue they're good companies, whether they're good value, but as another question. But like, why? What is pushing the trend more towards the private side? Like, what's the deal? Like, the companies are companies. Like, why
Yeah.
why is so much money going there and instead of the public side?
Yeah, it's a great question. There's so much money in the private markets now. What's happening is all that value creation that used to be able to get in kind of your small cap stocks is happening in the private markets. An interesting stat is that of the US based companies that have $100 million of revenue or more, which I would argue is a pretty mature company, right? $100 million revenue or more. Of the US based companies with 100 million or more, only one out of 10 is public. The other nine out of 10 are still privately held. And so, the stats are something like you used to be able to get into companies on the public side when their market cap was around 500 million or so. And that number is now closer to 5 billion. when they open, right? These IPOs aren't opening very much. And so people are staying private longer and they're able to do so because more and more money is pouring into the private markets. And I think the person that gets caught out is the individual household, right? You all along you've been able to participate in the public markets. You have equity, you have bonds, maybe you do a little bit of alternatives, but all that value creation from 500 million to 5 billion is now happening in the private markets. And that's where people often would have growth, right? That's where they create the alpha in their portfolio to make their money kind of work for them a little bit. And that's kind of gone away in the public markets. To your point, there's still companies to invest in. It still is a good investment. I'm certainly not advocating that people abandon the public equities market. It's been great for a long time. It certainly has volatility, but if you stay in, you get performance. But I think for people that are looking to sort of have that alpha or that differentiation, all that value creation is happening in the private markets, which is why everyone's looking to get into it now.
Yeah, it's interesting. I never thought of it that way. That because I've actually been wondering for a while, like why is the small cap market drastically underperforming for so long?
Mhm.
Like if you look at, I remember when I started in '99, they had these big like 100-year charts and they'd show the different asset
Yeah,
classes and what's the best one? Small cap. Small cap is the
right.
best performer.
Yeah,
And you'd see this and be like, well, obviously I want to put all my money in small cap, right? And so, but then you think about it, it's like it's drastically underperformed since pretty much 2000. And for the last 10 years, it's been abysmal.
right.
Um, and I always thought it was because it's too small for institutional money to get into because it's not going to move the needle for them. But the way you're saying it, it actually makes more sense. Like the good companies are just staying private. And
Yeah.
so then the question is like, why would you go public at all? Like if you're getting that growth in the private side, like what's the incentive to go public at all?
Yeah, I think from an entrepreneur's perspective, there's probably not much, right? I mean, with add in regulation, right? It's kind of happened 08, 09. It's become much more difficult to be a public company. And so from an entrepreneur's perspective, they're like, if I can keep growing and I can stay private, I will. But, there are investors in these businesses that would like a return. And I think ultimately when that kind of curvilinear growth, it kind of starts to stall out, it usually moves over to the public markets. That's not to say those aren't good businesses that are in the public markets, but when the next exit is the public, that's kind of when companies go public. And I think that's the reason that you have businesses that absolutely would have been public 15 years ago. And we're talking 100 million of revenue. You would have jumped to public because that was the place to be. They're kind of leaning, leaning into the private side and saying, hey, who else wants to invest in this great business? We're still growing 20, 30, 40% year over year. And so I think it's really the investors that are saying, "Hey, it's time for an exit. We've been in this business long enough. Let's bring it into the public realm." But I have not. We invest earlier than that when we do our investing, but I've not met an entrepreneur that says, "I can't wait to be a public CEO." It's just a different realm in terms of what they need to do.
No, I'm with you there. From what I understand, like the regulations are ridiculous, and to be a public company, a guy I know said this once, and I thought it was brilliant. He's like, he ran a private company, was very, cash flow rich, and he's like, if I ever go public, don't buy the shares because it means that it's the end of the cycle and I'm getting way too much for what it's worth and it's worth it to sell out. So if I ever go, and he did, and of course the stock's gone down like 90% when he
Yeah.
went public, but it's like, I mean, I get it. And I guess the only thing on the public side that I could say that I've seen for a great model is I'm trying to think who did it. Eddie Lampert did it, right? So he bought Sears and he bought, I think it wasn't Carmart. It was one of those AutoZone. Maybe it was AutoZone, where he basically just bought it and every year uses the cash flow to buy back shares. Right? And so he's slowly acquiring the company back, and then
Yeah.
he'll take it public again, and then have it. I mean, to me, that's a great model, like tax benefits, all that, and
Right.
and so um, I find this stuff fascinating. But what's so? Tell me a little bit about the. You guys do a lot of business development companies, and um, I've always been fascinated by that model. So tell me, what is a business development company, and how does it work?
Yeah, business development companies, I think it was created by an act of Congress back in the 80s. And the intent of the BDC or business development company, often referred to as a BDC. So if I use the acronym going forward, that we're talking about the same thing. And for a BDC was really to to fuel investment in the US. So it's focused on invest US based companies, privately held businesses, and a vehicle that kind of reduces some of the frictions of investing in the private markets, like the threshold of capital that you have to have, or the limitation in terms of the number of investors that you can have in a fund. And so the BDC was intended to do that. It didn't really take off until recently. And it really took off recently in the private credit space where you're loaning capital to businesses. And so there's a tremendous number of BDC companies and even evergreen BDC companies, which is another wrinkle. Um, but I think original intent was equity. And so we kind of spent time saying, well, we're trying to take our investment philosophy, our track record, et cetera, and bring it to kind of the every man or every woman in the US. And how can we do it in a way where we have an unlimited number of slots in this lower threshold? And so what's nice about the BDC is, as I mentioned before, accredited investor and unlimited number of slots. So suddenly we can now talk to everyone, right? Whereas before we only have 100 slots, and you fill up 100 slots pretty quick if you've been doing this for a while and you've had success. And so the BDC is nice because it's US based companies that you're investing in, has less in the way of limitation around concentration. In our game, you want to concentrate in your winners. You obviously don't want to concentrate in your losers, but it's nice to have the flexibility inside the BDC structure to be able to do so. And then you can build this long dated structure where you can have time, like periods of time every year where people can get in, and you can add this liquidity feature where people can get back out again. And so that takes a lot of the frictions and takes the power of the product, so-called a private market product, and puts it in the hands of the individual and their advisor, where it actually works a lot better with their workflow. And if they're interested, they get the benefit of knowing that the vast majority of your investments will be US based.
So, so you mentioned private credit, which I know is a big a hot button right now. Everyone's talking about private credit. So describe the differences between the two, and what is it you're like? Give me some examples of what you're actually doing in the
Sure.
BDC.
Yeah. So I'll do the private credit one first, and then I'll kind of juxtapose it to equity. Private credit is you're loaning capital to businesses that are kind of growing quickly in exchange for an interest rate on that money. Ultimately, as an investor, you expect to get paid for the loan for some period of time, typically 3 to 5 years, and then you're going to want to get that money back, right? So it's just a loan similar to taking out a mortgage or something like that. What's nice from an investor's perspective is you get a quarterly distribution. You get this current pay component distribution of, call it 2.5% of your principal on a quarterly basis. That adds up through time. You're getting kind of 10, 12, 13% of a quarterly pay distribution. The cap of it is it's kind of like capped, right? I mean, it's like you're loaning money at a price, and then that's the max price you'll get, and things sort of erode from there. But the difference is current pay. The equity side, you're actually putting capital on the balance sheet of these privately held businesses in exchange for ownership of those businesses. You take a 5% ownership, 10%, 15%, whatever the case may be. And then those are much longer holds. So you won't expect appreciation or distributions of cash for, call it, our average hold is about 6 years. And so, but the upside to it is you have an unlimited, theoretically an unlimited upside. So from an investor's perspective, you may invest, 10, 15 grand in one, 10, 15 grand in the other. One, you're going to get an immediate compensation for being invested. The other one, you're going to watch value appreciate through time, but it may be, a couple of years before you have your first distribution. And I think the investment philosophy, the people that are actually deploying the capital have to have a very different mindset in terms of what they're underwriting, their due diligence, et cetera, in terms of how they're going to get their capital and ultimately their return back.
So help me understand this because this is the part I didn't I've talked to people about this before, but it doesn't really make much sense. I'm sure there's a market for it, obviously, but if you're taking a piece of equity, loaning him money and taking a piece of equity, like what's the incentive for a business owner to do that? Like, I mean, you're gonna take a piece of my business and loan me money? Like, like why would somebody do that?
I think that's a relatively new model where you do both at the same time. So I think of them as two different, distinctly different types of companies. I'll come back to that hybrid that you just mentioned. The person who's going to borrow money is someone who's growing. They have a business that's got, I don't know, 90 to $100 million of revenue. They're probably cash flow positive. They're growing 50 to 70% year over year. Their options to continue to fuel that growth as fast as they want to, or I'm going to go back to the equity markets and sell off more of my business at whatever today's valuation is. or I can borrow capital and get to a higher valuation and borrow money in the future, right? So one's much more dilutive in terms of their ownership. And so from an entrepreneur's perspective, they're like, I want to hold on to more of my business. I got something special here. Let me just borrow some money to get through this next hurdle, and then I'll raise and dilute myself less when I sell at a higher valuation. On the equity side, it's like I don't have enough of a business yet where people are willing to loan me money. It's just way too risky. And I need help to build and scale this business. And so if you're going to take on a private, whether it's venture capital, growth equity, private equity, you're bringing on not only capital, but hopefully expertise to help you grow and scale your business kind of faster and farther than you'd be able to on your own. And you're happy to make that trade. I'm sure you're giving up some percentage of your business, but the probability and the ultimate valuation in the future, um, should be much greater by doing that partnership than they wouldn't. What's interesting, and you just mentioned this, Kirk, is sort of like this hybrid. Like, why would you do both at the same time? And I think this market that we're in right now is relatively repressed in terms of multiples that people can raise capital on, if they can raise capital at all. And so if you have an entrepreneur that's like, I'm doing well, but the markets haven't rewarded me for it yet. I need more capital to get to where I want to be. They may do a little bit of a way to hybrid that. Well, let's just say they raise $10 million of capital and they bring 6 or 7 million in equity and they do another 3 or 4 in debt. They can kind of like cost average in the cost of that capital where they're only diluting themselves by the 6 million and then they're borrowing the 4 million. It's a way to sort of middle ground it where they get the full 10 million to grow and scale the business. No one would loan them 10 million based on the maturity of their business, but they don't want to give up 10 million of equity either. And so I think we're starting to see this sort of hybrid appear where it's a little bit of both camps to really serve the entrepreneur in a way that gets them through this particular time in time.
Yeah, it's interesting. So I think about it. It's like I think about my business. Like if I was ever to give away equity, it would be because I've hit a roadblock and I can't get past it and I
Mhm.
need some help, right? And taking on a partner, if you will, who has an expertise in a certain area who can do that, like that's worth it. It's always been worth it since I started the business. Take on a
Right.
partner, sure. You're going to be able to deliver enormous value to the business. I absolutely. Um, but it has to be able to deliver that value or else you just made a really bad mistake. But taking on debt is great if you're growing a lot faster than the interest you're paying on the debt. Like you said,
Right.
you're growing at 50, 70%. Yeah, sure. I'll take on a 10% interest. Happy to do that.
Right.
Like
Right.
I'll do that all day. It's like the Michael Saylor's approach. It's like, yeah, I'm going to borrow at zero and I'll give you a convertible and it's all in Bitcoin. So as long as it keeps going higher, we're all rich. And if it goes to zero, well, we're all screwed. But
Yeah.
you know, it's you're taking a you're trying to engineer the difference out based on what you think the company's going to do. Um, but yeah, I'm just trying to think through like okay, so you guys do kind of contribute. So it's like venture capital, you kind of contribute, or private
Yeah.
equity, you kind of contribute your knowledge worth into the equity. It's not just equity, it's like
Correct.
something else.
Yeah, I think that's a real differentiator of us. We're kind of we call ourselves active investors. We mean that in the most positive way. As you pointed out, not every business should take money, right? If they shouldn't. If they're doing well, if you're bootstrapped, you're growing and scaling your business, keep doing it. I think the reason to take capital, institutional money, venture capital, growth equity, et cetera, is because 1 plus 1 is going to equal way more than two. And there's got to be value beyond just, hey, we're selling money. And so we've built out an entire group called the Performance Engineering Group. Those people work closely with our entrepreneurs, really around three big things: talent acquisition. We often invest kind of first institutional capital. These businesses are not fully formed in terms of their leadership teams, and they need help with often with a finance function, often with a marketing function, sometimes with sales. But building out that leadership team helps them get from A to B in terms of the maturity of their business. Go-to-market motions often need help in maturation. And then the third one is actually financial metrics. You start a business, you sell it to a couple of people, you're providing value, but you don't really have a good handle of what's happening with the kind of metrics of the business. And so saying, hey, you're spending X here, you're getting Y back, you're underspending here, overspending here, just getting those metrics set up so you can start to track how the business is performing and then make informed decisions based on that data are some of those key components. And so, to your point, if you're good and you're growing and you don't need help, I wouldn't sell equity. I wouldn't borrow money. I would keep doing what I'm doing. But I think a lot of people get to these nodes where to get over the hump to that next phase of growth, they need something, whether it's capital or capital plus help or opening doors, unlocking, et cetera. And I think that's the right place for an entrepreneur to think about, who's the right fit for this sort of problem or challenge that I'm having with my company.
Yeah, and it's interesting to me. When it comes to how much involvement um do you have in companies? Because I know, private equity tends and venture capital tend to take like a heavy hand in
Mhm.
the company, and in many ways rightfully so. Like that's the point. Like that's why they're taking the money, is because they're looking for that kind of next stage driver that the business owners are ill equipped to deal with. Um, but at the same point, they're also giving up control at some point where it's like you either do it or you're out. So you're putting yourself in a position where you can get this help, but if it doesn't help, you're pretty much, the business is not going to fare well, or you're outed, right? You're
Yeah.
fired. So how do you handle that with small business owners? Because small business owners, like, somebody came in and said, if I had a choice of like, hey, we're either going to go to the moon or we're going to go to zero, I'm like, I don't know if I want that
Yeah.
choice.
I don't like
Like,
that binary bet.
yeah, I'm not
Okay.
game with that, because I know
Yeah.
you want to go to the moon, but if I
Yeah.
don't, you're happy to let it burn, and I'm like, I'm not happy to let it burn. So like, I wouldn't take that choice. But um, it's kind of, what was it? What was the guy FTX? What was that guy's name?
Damn.
The guy
With
who
his
ran
name.
FTX,
Yeah.
the guy who went to jail.
Yeah.
Anyway, so his whole thing was like, you ask him a question, he's like, if I could make the world a better place, or it would kill like 100 million people, would you take that bet? And it was 50-50. He's like, absolutely. I'm
Yeah.
like, you nuts. Like,
Yeah.
you're cuckoo. Like, there's no way I'd ever take that. That's just wrong on so many levels. But that's kind of, I know there's that piece of it. So how do you have that conversation with business owners where that is legitimate? Because it's not like it's one-sided and you're like, heavy handing them because you're trying to make them do things you want, but it can be a real decision because sometimes things don't come out. So like, how do you work through that decision with a business owner?
Yeah, I think it comes down to alignment from the beginning. I mean, we've all heard the sort of uh, private equity stories most commonly where they buy the whole business or some piece of business and it's got someone's name on it. And then next thing you know, the person whose name is the business is no longer in the business anymore. Those are private equity deals in particular, sort of they're relatively short timelines or somewhat financially engineered, et cetera. Our strategy is really, it starts with alignment and partnership. For us to meet with these companies, we expect them to be like marriages. We're going to be with these people for, like I said before, on average 6 years, sometimes longer. And we got to make sure we're looking for the same thing. If someone's running their business and it's doing okay and they want to sell it when it hits 50 million in valuation, it's probably not a good thing. That's not what we're looking to do. So I think it starts with alignment there. And then, I think a lot of the West Coast, particularly in the venture space, a lot of the West Coast firms that kind of built the space really do turn their businesses into these binary bets, right? They flush them with so much capital. They're either going to become the category leader and win, or it's going to be really hard to raise additional capital. And I think that's risky in terms of coming into a binary bet. We take more of what I would call a modified options approach, where we're doing smaller amounts of capital earlier. Or entrepreneurs keeping more of their business through that approach. We're putting less capital on the balance sheet. We're kind of thinking about this more as stair steps, where we're working through these challenges 1 year, one problem at a time, and then using these BDC funds that have, continuous capital to then follow on and follow on and follow on. And I think we did a study on this before, that the data shows that the probability of success for the entrepreneur goes up with that strategy. It certainly feels good when someone says, "Hey, I'm going to give you 50 million bucks because you're awesome." But if you follow that through time, the probability of failure goes up much higher from the entrepreneur's perspective, and they own less of their business at the end of the day. So I think this modified approach, where we're doing smaller amounts of capital, taking smaller ownership, and kind of working through the challenges in front of them, it's easier to raise capital. It's easier to prove that you've made success from point one, point A to point B. then ultimately higher probability of success and more ownership from an entrepreneur's perspective. But it really comes down to alignment. We want to make sure that we're both looking for the same outcome. And as long as we're aligned with the entrepreneur as we're moving forward, it's a lot easier to have conversations around, extreme one, easy one. Hey, you're the CEO, but you're really best as a CTO, right? Like you're the technologist that's built this business, the solution or the technology that we built. You don't want to be dealing with HR problems and raises and the sales team and the marketing team and all that stuff. Like, what do you think about going back to that CTO role where you're uniquely suited? And if alignment is there, that's an easier conversation. It's never easy, but it's an easier conversation to have than, hey man, it's CEO or bust and I'm out. And then suddenly you're in this upside down situation that you don't want to be in.
Yeah, I imagine that's a tough conversation. I've had conversations with business owners a lot in the past, and it's part of it's an ego thing in the sense that their identity is tied up in their business, and if they're not the CEO, well, I'm just the janitor in my own business. Like,
Yeah.
well, if you're a really good janitor and you're really crappy CEO, then that's logically you're still the owner, but
Yeah.
logically that's who you should be. Like some people, like I met a guy in my industry, and he just loved analyzing companies. So he hired a CEO and he just does analysis and portfolios and like, stocks and all that. And that's all he does. But he owns the company. But he's like this lower level peon. And it was just hilarious to me. I was like, that's really smart. Like
Yeah.
most owners would not do that because it's like, well, this is my company. Like I'm in charge. Like so I
Yeah.
imagine that's a very difficult conversation to have.
It is. It takes an awareness and a humbleness, and it's usually not one, right? It usually ends up being a year long of discussions to help people sort of see the same thing to ultimately say, you know what? You're right. What I really love to do is X, and I'm comfortable just moving into the X, the X seat, so to speak, and allowing someone else to help and grow scale this business. It's very rare to have, the Zuckerbergs of the world that start something in their dorm room and decades later are still the head of the company. I mean, most people are good at a phase, and it may be 1 to 10 employees, 10 to 100, whatever the bucket is. Most people are really good at one, and that's what they love to do. And once you can help them realize like that's your superpower, that's your like asymmetric, that's where your strength is, they either can move back into that role or recycle, right? Like move the company on and go do another one or whatever the case may be. But it requires alignment, trust, and often more than one conversation.
Yeah, no, that's for sure. Um, So I want to get back to the private credit because I find that interesting. Um, you know, there's a lot of the banking industry's changed a lot in the last 20 years. 2008 didn't do them any favors.
Mm-mm.
Um, in some ways, it makes me wonder what the purpose of banking is anymore because they're not they're not lending out to individuals, they're not lending out to business owners. They're there's all these things they're not doing because for regulatory reasons, all these other
Yeah.
things. Like, what are they actually doing? I don't know. But with a private credit market, which was certainly there to fill a void, because that void's been there since 2008, and I'm
Mhm.
surprised it took so long to fill. Um, where do you see things going in the future? Do you see that continuing to expand and like banks just do less and less and private credit does more and more? Like where do you see that going?
I think so. I mean, unless there's another kind of cataclysmic event that changes, but you mentioned 2008, which is absolutely when it started. Then you had these banks like SVB, Silicon Valley Bank, Signature Bank. We had that crash, what feels like a long time ago, but wasn't actually that long ago.
It was
They
like
were
two, 3 years ago.
yeah, they were actually the ones that were kind of at least trying to fill that void, right? And they got out over their skis, and that's sort of well documented as it stands today. But they were doing what I would call kind of venture lending, like an equity backer put some money on the balance sheet, light due diligence on their part. They'd put money next to them with the expectation that the equity owner would bail them out if they needed to. That's gone. I mean, and probably as it should be. We don't think that early stage businesses should use a loan to fuel kind of business operations, so to speak. Um, and these direct or these hard money lenders, private credit, as you mentioned, are the ones that are stepping in. And what you end up having is people that, every day, that's what they wake up and they're doing. They're underwriting these businesses based on, where they see a business model. And a lot of people will do it, based on EBITDA or size of the business. And, they put in covenants to protect them and whatnot. But I think there's a lot of other areas of opportunity to be successful that's more of this concept of enterprise-based lending, where if the value of the business is $200 million and your loan to value is 10%, you're loaning 20 million bucks to this business. It could come down a tremendous amount in terms of value, and you're still made whole as a lender. So I think the sophistication and the professionalism, not the other people who aren't professional, but the focus on just doing lending into whether it's the private space, particularly the private space, um, that will continue to grow. I mean, it's quadrupled from 2016 to 2024. It quadrupled in size, and kind of expectations are it'll quadruple in size again. That ends up being like a $3 trillion space where people are in this private credit, direct lending into these growing and scaling businesses. So I think it's here to stay. I don't think the banks are going to come back in and change the course, the direction of that. And I think from an investor's perspective, most people are kind of 60-40 for the longest time, and they're used to being in equities and bonds. And now I think from the individual household, they have to think, okay, well, there's equities in their bonds, but there's both public and there's also private, and kind of wrap your head around where do you want to be exposed relative to those four kind of bigger buckets. There's alternatives in there as well, but I think it's here to stay, and I think it's going to be a direct lending space, not a bank space.
So now because obviously the difference between public and private markets is liquidity. So, you can invest in public BDCs, and, certainly banks have their own, competitive edge. Um, so where do you where do you see the value? Because we haven't had a recession in, I don't know, 20 years.
We've been talking
I,
about it a lot.
yeah, 15 years, I think
We
it's
haven't quite
been.
got there yet, but talking about it a
Yeah,
lot.
it's been a while. So, I mean, when one happens, people go running for the exits. So, how does that play in? Because inevitably we will have one at some point. Maybe we won't. Maybe recessions are gone forever because they've solved this problem, solved it.
Maybe.
But what does that look like in the private credit space? Because it's getting a ton of money. I know. I remember 2008. I remember what happened. It was not pretty. It's pretty if you had a bag of cash because you just walk
Yeah.
around and just pick up deals.
Yeah.
But most people it was not pretty. I mean, I saw REITs, non-traded REITs going for like 8 cents on the dollar. That's not what they were worth, but that's what people were paying just to
That's
get
what we were
out.
favorite. Yeah.
So, how does all this sort out in a bad recession?
I think the space en masse will do exactly what you just expected. I think that there's a lot of people that are raising private credit funds now that probably shouldn't. And in order to put that money to work, they're having to do things that unknowingly pass risk onto their LPs. So, the lower cost, meaning the lower interest rate. They'll take out covenants, where they don't have as much control over the business. They'll use it too much leverage, where they're borrowing a bunch of money to lend the money, and when that house comes crumbling down. So I do think there will be. It's just so hot, and it's been so hot over the past couple of years. I do think there'll be the reckoning that you kind of referred to, where a lot of people will lose money, and I think a lot of people will be out of business from a GP perspective because they haven't done good stuff. I think a lot of that will happen in the bigger markets where people, these funds people are raising now are massive. I mean, it wasn't that long ago when if you raised a $1 billion fund, people's eyes would pop out of their head. Now there's like $1 billion funds being raised, even in this market, what feels like daily, but probably weekly. And in order to put that money to work, you gotta be putting to work like 25, $50 million at a pop. And so there's just so much competition to put that money to work that, in my opinion, people are starting to take shortcuts where, less cost, less covenants, more leverage, whatever the case may be. And I think that sounds great now, but it's kind of this unsuspecting risk from an LP perspective. So I think from someone who wants to get into private credit, I do think there's good private credit out there where people have a differentiated strategy. They're not forced to take those corners, but you have to look a little bit harder and go where the money isn't. I think it's like anything investing, right? The obvious play, if it's obvious to everyone, there's probably not a tremendous amount of alpha there. And so I think there's plenty of money to be made. I do think private credit will stay. The good managers are doing a good job as it stands today, and they will continue to do a good job even when this reckoning comes. But I think it's just so hot right now, and there's so much money going into it. I agree with you that if something bad's going to happen, as they say, and whether it's a recession that causes it or not, There will be a bunch of people that are raising funds now that won't be raising a second fund.
Yeah. So we're gonna wrap it up here. We're kind of running out of time, but one kind of final big question. What are your thoughts on AI? Like, where's this? You mentioned earlier in the conversation, and you said there's no venture now, but like, what are you seeing with AI? What are the applications or opportunities in your field or just in general?
Yeah, I mean, I'm a huge supporter of AI, so I don't want people to think like, hey, that ship has come and gone, and you're not going to participate in it. I think that like the big money deals from an AI are building the tools. And I think what's really interesting from our seat is watching all those tools now be used in all of these portfolio companies. We say if you don't have an AI plan as a portfolio company, you're missing the boat. Like you're going to just get passed by. It becomes this just exceptionally powerful tool in the tool belt of an entrepreneur as they're building their business. They can do more with less, they can hire less, they can service better. I mean, there's just all these incredible ways that they can use AI to make their business more efficient and effective. And so I think what's fun and interesting for us to see is how it's all happening. Like we're using it internally for us to just be able to serve up interesting data analysis. We have just reams and reams of data from all of our portfolio companies. On a monthly basis, it's hard for us as GPs or investment committee to like get through it all and know what's going on. And so having AI start to assess all the information and serve it up to us in much more digestible ways is making our business more efficient and more effective. And so I think AI is absolutely here to stay. And I think it's really exciting to see how the different tools, whoever the platforms are that win, we'll have more than one, but these are the big kind of OpenAI, ChatGPT, um, et cetera, how those then get put into these companies and make them more efficient and effective moving forward is a key component of our diligence. If you go and talk to an entrepreneur and they say, yeah, we're company name dot AI, you're kind of like, that seems like a gimmick. But if you go talk to someone that has a normal name and you say, what's your AI plan? And they have this sort of sophisticated plan of what they're doing, that's what's really exciting to see how these companies can be much more efficient and effective that way.
Nice, nice. I like that. Well, as we kind of wrap it up here, Mark, I appreciate you coming to the show. Final thoughts from you, and where can people find more about you?
Yeah, well, I really appreciate you having me. It's been a lot of fun to chat. I think we're at a really interesting time as we kind of move through and people get comfortable with the private markets relative to their investments in the public markets. You can find me at BIPcapital.com is our website. There's a bunch of information there and kind of the things that we do. And then always interested in seeing people on LinkedIn, Mark Flickinger. So thanks again for having me, Kirk. I appreciate it.
Awesome. Thanks for coming on, Mark. We'll probably have you back on in the future because this space is constantly evolving. So appreciate you joining us.
I look forward to it. Thanks.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Mark. Really appreciate him coming to the show. Now we're into the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Hi, happy to be here today.
Glad to have you. And we also have our newer panelist, Diana Perkins. Hey, Diana.
Hey, Kirk.
Glad to have you in the show. And so let's just dive right in. So, Barb, what were some of your takeaways from the interview?
There's a lot of people that are touting alternative investments, and that's and private investing, and that is a very wide umbrella. It it could be startup businesses like this guest discussed today. He invests in venture capital startup businesses. There's also opportunities to invest in real estate debt. I mean, there's so many different type of private investments available. And we've talked about this a lot. My basic thinking is know what you're investing in and know who is at the helm of that investment.
Yeah, no, I agree. I think those are good points. Diana, what about you? What are some of your takeaways?
Yeah, the biggest thing that struck me was just around the theme of the democratization of alternative investments. So, along the lines of what Barb was stating as well, alternatives are becoming more and more accessible to the retail trader in different forms. So, I love just that topic in general. It's a very, I think, on trend topic as well. And related to that, something that Mark had mentioned that I thought was intriguing is this almost like four quadrant framework, if you will, where he talked about the 60/40 stock bond portfolio and then bifurcating it another level to public and private. So I thought that was an interesting perspective. I know for a while what's been out there is this idea of a shift from, strictly stocks and bonds to alternatives, maybe a 30, 50/30/20 split between stocks, bonds, alternatives. And now that alts are becoming more accessible to the retail investor, I think it's just fascinating as retail investors look for ways to diversify their investments with more uncorrelated assets.
Yeah, I think the uncorrelated part's certainly what people are seeking, and it's certainly gotten harder and harder to get in the last 25 years, I would say. So that's an interesting angle on there we can get back to. So Barb, when you're thinking about alternatives, um, how do you think people should consider this? Because not everybody's a bazillionaire; they can't all invest in alts. So how do you think people should be thinking about alts in their portfolio?
Well, I really want to jump on the trend of uncorrelated because I think the returns I mean, the stock market returns have been incredible for the past 100 years. Now, I don't expect them to be that high going forward because, frankly, the stock market is really overvalued now. But during our last significant downturn, both stocks and bonds declined. Now, that's not supposed to happen, and it doesn't typically happen. So, the idea of gaining uncorrelated assets, which means when one asset goes down, you'll have another one in your portfolio to balance it out, in theory, is a good idea. The problems with private equity are number one, they're private, so you're not going to get the regulation. You're not going to know as much about them. So it's on you to really investigate who is running this fund and what fees are you paying. I happen to be a cheapskate. I don't like to pay high fees because the reality is over time, lower fee investments have outperformed. If you're paying for, say, one is really way too low, but let's say 2, 3, 4% for investment, that investment has to earn north of the fee in order to even make a difference. So that's one concern. My other concern are lockup costs. Nearly all private investments, they tie up your money for a certain period of time. And so you better not put money in that you're going to need within the next 3, 5, 10 years. So those are just a couple of my thoughts, a couple of my worries.
Yeah, no, those are good points. What about you, Diana?
Yeah, I agree with the theme around liquidity, especially when we look at private equity, real estate, and making sure that if there is that lockup period, or if it's, a longer term to see those returns come back to you, that you don't need that capital right away. So just like something like cryptocurrencies, which is also a big trend right now and blockchain technologies and tokenization, things like that, there are these extra layers and considerations that I agree with Barb that we need to consider as investors, or for those listening, should consider and educate yourself, whatever that area is, whether it's a matter of liquidity, doing greater due diligence on the company that either you're taking partial ownership in or lending to. So those are a few initial thoughts. And then also when we talk about the accessibility, thinking of BDCs, I know that came up in the conversation as well, and other ways through the public markets where there may be more liquidity. And REITs, of course, we've talked about that before, where the general, I'll call them, everyday retail investor can get a piece of that alternative pie in the public markets and maybe, bypass some of those layers, but not all of them. You always should understand what you're investing in.
I want to jump in real quick, Kirk, because it reminds me I've invested in the past, although not recently, a lot in closed-end funds. And those are publicly traded, but you can get a lot of different types of investments within a closed-end fund. And also mutual funds. We think of those as like, who invests in a mutual fund anymore? But there are thousands of mutual funds. And there are hedged mutual funds, there are alternative asset mutual funds. So if you want some uncorrelated assets with a certain level of regulation and liquidity, you might consider those before you go jumping in and tying up your money for a long time. And also, they'll have much lower minimums. So I know the private equity is so glamorous, but I always like to say kind of beware.
Yeah, it it's interesting. I think a lot of people get drawn in by the sex appeal of private investments. This is gonna be awesome. All my friends are doing it. All the rich people are doing this. It's so cool. I want to be like the cool kids. It you know, I've gone back and forth on this personally over the years, and I have nothing against private investments, just to be clear. We do a lot of them, with our firm, but I kind of go back and forth. And just being frank, like if you have an edge, right? If you're starting Facebook and you clearly have an edge on something, um, well, okay, right? That's great. But if you're just trying to start another dry cleaner company, which can be very profitable, by the way, and that's probably a bad example. But if you're trying to start, I don't know, a McDonald's clone, and you're competing with McDonald's in the public market, and you try and do that in the private market, well, I mean, are you going to beat McDonald's? Probably not, right? That's going to be hard to do. They're pretty efficient. So maybe you should go in the public side. Maybe you should just go with McDonald's instead of starting your own, right? These are questions you have to ask, and not get drawn in by the cool factor. Look at it as, what is the illiquidity worth to me? Can I ever sell this? I'll give you an example. Like I know a guy who's got shares in a family company, and he can't sell them. He gets some cash flow, which is great. You know, the whole family does, but he can never sell it. Um, and it's an asset that has no value. Like it's income, but the asset itself, like there's no value because he can't sell it, right? You can sell it to other family members at a huge discount, you know. So there's all these different aspects that I think people don't realize. And if you're running your own company, you can do whatever you want. But you know, if you're investing into another company where you really have no power or control, which to be frank is a big part of this. Once you invest, you have no power, no control if you're a minority shareholder. So you're you're pretty much sitting back here with popcorn hoping it succeeds. That's not a great way to invest. You do that in the public markets for sure, but the public markets I can get out. If I make a mistake, oh crap, I made a mistake. Let me just get out. I can do that. Take me half a second. But in the private markets, you better make darn sure because you can't get out until they liquefy it or you find a buyer, which is next to impossible to do. So I think people need to be aware. There's some great opportunities. Um, but you know, let me ask you this, Barb. Um, you know, because there's the way that the wealthy invest into, you know, private equity funds or venture capital funds, but how can like mom and pop retail investors who are maybe not accredited look at an asset class like this?
Fortunately, today we have something called crowdfunding investing. And it's a fancy way of saying there have been quite a few companies um, that have come out with private equity deals for the small investor. And I actually have, I think, an article on that on my website. And what it is these different types of apps, they will invest in startups, or they might invest in art, or they might invest in litigation funding, which I find just really interesting, which is when a lawyer has a big class action suit, they don't get paid until they win, if they win. So you can be an investor in that and hopefully participate in the big win or not. So there are a lot of these different types of crowdfunding apps, platforms that are available to small investors, and many of them really don't have too high of fees. And so I personally think it's not a bad way to dip if you're just a retail investor and you want to check something out. It's not a bad way to dip your toes into a different asset class. I have a rule of thumb that is take 5% of your total investment portfolio and do whatever you want with it. Private investing, cryptocurrency, whatever. And individual stocks, options trading, day trading, because you can afford to lose, most of us, 5% of our portfolio. And then put the rest in public markets, stocks, bonds, and then try it out.
Yeah, I think that's a good strategy. Um, what about you, Diana? What are your thoughts? Um, you know, should everyone do this? Is this something that, you know, only the wealthy should do? Should the people with who are not accredited be doing this?
Yeah, I see I'm an opportunist personally, so I see no problem with getting involved. I like Barb's rule of thumb, 5%. It reminds me of my rule of thumb, which is don't trade anything you can't afford to lose. So I think that that's very similar. And so I would extend that to asset classes like alts and cryptos and maybe areas that either are based highly on speculation or tend to be more volatile. So we talked about, hey, there could be higher reward in some of these PE investments that are given a longer time frame, but at what risk, at what cost? There's always that teeter-totter in your investment. So I think if you're smart to, okay, what are the risks involved? How am I managing that risk? Do I have the appetite to take on that risk? And then, of course, looking at your time frame, we talked about liquidity and those types of factors. So I say absolutely dip your toes. Like anything, educate yourself. I know some folks there might be one industry that they're very knowledgeable about. Maybe you work in the medical field and there are certain alts in that space that you understand really, really well, and you want to go where the other people aren't, right? Buy the rumor, sell the news. If you're in the thick of it already, maybe that's how you get your edge. So I would say if it's accessible and you have the appetite for the higher risk, maybe volatility, speculation, do your due diligence. I'm also a CPA. Do your due diligence. The ex-auditor and me talking, but absolutely, dip your toes in, try it out, but just do it in a responsible way.
Yeah, I think what's interesting is, if you look at how Wall Street's constructed, the retail investors primarily focus on equity, whereas a lot of the institutions focus on debt. And people think, well, debt's boring, you're not getting good return. But if you do it right, you can and will get a good return. I know a lot of bond investors are making well into the double-digit returns. Um, you know, you, I think we get lured in by, once again, the sex appeal of equities, and the hope that I can make $1 million on this investment. Whereas, smart investors, the bond investors, are saying, well, if I can get 15% a year, I'm happy. Whereas the equity investors are like, I want 100% in a day. There's a very different mindset attached to that. Now, you could say, yeah, I'm a long-term investor, and that's great. But, I think a lot of people don't realize that you don't have to invest in equity. You can invest in debt. Like I talked to this firm, they were a venture capital firm, and they got into like sort of the business development company space. It was kind of a hybrid of that. But basically what they're doing is they're doing high interest loans to companies that had good credit ratings. And then they were taking equity slice out of it, but they're basically loaning them money. And this is back 0% interest rates. Maybe they're doing like 9 to 12%. Plus they get a slice of the equity, and so the point is there's lots of ways to make money. It doesn't always have to be equity. Debt in many ways can be easier and cheaper, because it's debt, it's 5-year note, whatever it is, like it's 5 years. And in 5 years, I'm out. Whereas equity, you're never out unless they sell. So, there's a lot of advantages on the debt side that I think a lot of people don't recognize. Like we do a lot with private mortgages. We know a handful of people we've worked with for many, many years that do fix and flips and rehabs, and they're making 20, 30, 40% returns. Our clients may only make like 12%, but it's backed by real estate. It's backed by, the personal guarantee of the person. It's backed by a lot. So it's not really high risk. I mean, it's higher risk than a treasury, but it's backed by a lot of assets that are worth more. But if you were trying to do a fix and flip, yeah, you'll make a better return, but you also might make zero. You might lose money, right? The people all quit. We have COVID. Now you're stuck with this property and carrying costs and all this stuff, right? So sometimes debt is better. And I only say this because no one ever thinks about it. I mean, try to buy a high yield bond in Wall Street, they'll laugh at you. They're like, yeah, you don't want that. You want an equity. You want to buy a mutual fund, right? And it's in your best interest to do so. Whereas, if you know what you're doing, bond investors can do very well. It's not for everybody though, but it's just, I just want to bring that lens into the conversation because it's frequently overlooked. So, one thing that comes up, Barb, is, when people are thinking about investing in private, I know there's been a huge trend. We talked about it on the episode, but we had Dan Rasmussen on a few months ago, and he talked about this. And it was the first time it just stuck to me that this is happening. That we've had this great run in small caps the last 100 years up until maybe 20 years ago, and they've just kind of gone flat. And the trend is like, let's keep it private for longer, which is interesting. Do you think, because you're a diversification gal, you're into modern portfolio theory, do you think it's even worth doing small caps anymore in a portfolio? Because they don't seem to be growing. The companies aren't coming public as small caps, they're coming in like mid to large caps. So how should people be thinking about the small cap category?
That's a really good question. And I thought our guest really gave some interesting data about how the small cap companies segment has really, really shrunk. And so it looks like if you want to get a piece of real small caps, you might have to go private equity to get a bigger piece of that. I don't know. I have not done that. I do own a small cap ETF just due to diversification. I don't have a lot of a great percentage of our portfolio in that. So, you know, it's kind of the same. It's kind of the same, but different in saying, well, value's been underperforming so long, is it dead? Now, value has not changed fundamentally, except it's been out of favor as PE ratios have just gone through the roof and valuations have gone through the roof. And my belief is they are way overvalued and we are going to see a correction. So that's my answer to value. But to small cap, I don't know. I honestly don't know. I like small cap. I'm going to keep a portion invested, not a big portion, because I don't want to go through the aggravation of vetting these private companies and paying their fees and tying up my money. I just, some people don't care. I don't have the patience for it right now. So, yeah, small cap has fundamentally changed. I'm not sure what you do about that because small cap historically has been the fastest as growing asset class over decades, not recently, but in the past. So my answer is I don't know.
All right. Well, thanks, Barb. What about you, Diana?
So for me, I tend to focus more on large caps. As you know, I tend to hold positions probably, 3 to 8 weeks. So generally not long term. I do have a few favorites, although I say never be married to a trade or investment. But that said, I thought it was very insightful what the guest had mentioned about with those statistics to give us insights into the potential reason or driver behind the decline that we're seeing in the small caps. But my primary focus is typically large caps. But I like that perspective that Mark brought because it gives you just, one more kind of piece of the pie to understand, hey, this is where, this is why that private space is staying private right now. And some of the companies he mentioned, 30, 40% returns in a year, again, at what risk? But it almost, kind of feeds into that appetite to maybe go off the public market, explore the private a little bit more in that area.
Yeah. Okay, cool. Well, we're gonna wrap it up here. So final thoughts from you, Barb, and then where can we find more about you?
One thought that just stuck in my mind during this conversation, I've been investing for 40 years. And one of the things, if you're in the investment markets, I don't care what you're investing in, you're not going to be perfect. It's kind of like you think about baseball. If you're hitting, 300, you're doing amazing, right? Well, in investing, you definitely want to have an average hit rate of greater than 300 because that would mean 70% of your picks were bad. But in investing, you want to expect that you're going to have some losses. You're going to pick some losers. Or as Diana is a trader, you're going to have some trades that are going to go south. I'm a long-term investor. You're going to have some funds or some individual stocks that are going to go south. But historically, if you believe that American and global businesses are going to continue to grow, which I do, and you have the stomach to tolerate, you're going to have periodic losses. But as long as your gains are much greater and the investments you have outperform those losers, in the long run, you're going to be fine. So don't be afraid of a loss here or there. If you're in the public markets, cut your losses, quickly get out, find something better, and be prepared for volatility or stay in cash. My name is Barbara Friedberg. You can find me on YouTube as well as on my website, Barbara Friedberg Personal Finance.
Great. Thanks for coming on, Barb. And Diana, what about you? Final thoughts from you.
Sure. So I would say as retail investors gain greater access to the alternative space, and even with, with blockchain technology, tokenization, there's all these different areas that are also evolving. I would just remind investors out there, stay knowledgeable, go beyond the headlines, understand what you're investing, be open to it because we want to evolve. I think some of these technologies are very lucrative and could be great longer term plays, but we need to understand where we're putting our money so there isn't a shock down the road. The other thing I'll mention, and this actually ties into what Barb was just saying about having the right expectation going into investing because it does involve risk. Now, as you know, I tend to be shorter term, but we have this analogy of 10 trades, we call it, where you have a basket of investments, or in this case, trades, and the expectation is maybe you have 2 to 3 that do really well and you want to ride those up. You might have 3 to 4 or, so in the middle that are a little, around break even, small loss, small gain, and maybe, 2 to 4 on the lower end that are just duds, right? And so you want to manage your risk. I would say, about 50-50 win-loss, and make sure that you're cutting your losses short and running with your winners because they'll pay for your losers. So it's that perspective going into investing. So if we do, fall into another recession, I know the markets are going up, up, up. But if we do, you can understand that, understand what's happening, and have that longer term view, even if you're getting in and out in the shorter term.
Where can people find more about you, Diana?
Sure. You can find me on my website. It's tradingwithdiana.com. You can schedule a one-on-one with me, or there's lots of free informational resources out there as well.
Nice. Awesome. Well, thank you both for coming on the show. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.